Have you ever noticed how some things in life just make sense? Like, it's probably not a good idea to stand outside in a thunderstorm, or eating vegetables is likely better for you than a diet of just donuts. Well, the world of investing is no different. It's full of complicated schemes and get-rich-quick promises, but the truth is, the most effective approach is often the simplest. Just like in other areas of life, using your common sense when it comes to your finances can make a world of difference. The Little Book of Common Sense. Investing is more than just a financial guide. It's a beacon of clarity in a world often shrouded in complexity. Bogle's central message is simple, yet profound. The most effective way to build wealth over the long term is to invest in a diversified portfolio of low-cost index funds. This approach allows you to harness the power of the entire market, benefiting from the collective growth of hundreds or even thousands of companies. He exposes the pitfalls of market timing, demonstrating why trying to predict the market's ups and downs is a fool's errand. He also shines a light on the often hidden costs associated with investing, showing how even seemingly small fees can eat away at your returns over time. Bogle emphasizes the importance of patience, discipline, and staying the course, even when markets get turbulent. Now let's dive into the heart of Bogle's investment philosophy, the power of index funds. Imagine trying to build a house by crafting each individual brick by hand. It would be incredibly time-consuming, expensive, and probably wouldn't turn out as well as you'd hoped. Investing in individual stocks can feel a lot like that. Index funds, on the other hand, are like buying pre-assembled sturdy bricks. They represent a basket of stocks, like buying a piece of the entire stock market all at once. Instead of trying to outsmart Wall Street, you're essentially hitching your wagon to the performance of the entire market. And guess what? Over the long term, the market tends to go up. That's the beauty of index funds. One of the most appealing aspects of index funds is their versatility. Just as you wouldn't build a house with only one type of brick, you wouldn't want to limit your portfolio to a single index fund. Fortunately, there's an abundance of index funds available, allowing you to create a diversified portfolio that aligns with your financial goals, risk tolerance, and time horizon. Want to invest in the entire US stock market? There's an index fund for that. Prefer to focus on international markets? There's an index fund for that too. Let's talk about one of the most pervasive myths in the investing world, timing the market. It's a tantalizing idea, isn't it? Swooping in to buy low when everyone else is selling in a panic, then riding the wave back up to sell high and rake in the profits. It sounds great in theory, but in reality, consistently timing the market is about as likely as winning the lottery. Even seasoned financial professionals with access to mountains of data and sophisticated algorithms struggle to get it right consistently. Trying to predict its short-term movements is like trying to predict the weather months in advance. You might get lucky occasionally, but you're more likely to be caught off guard. If trying to time the market is a fool's errand, what's the alternative? It's simple. Time in the market, not timing the market. Think of it like planting a tree. You wouldn't dig it up every few months to see if the roots are growing, would you? No, you'd plant it, nurture it, and give it time to flourish. Investing is remarkably similar. The longer you stay invested, the more opportunity your money has to grow. The earlier you start and the longer you stay invested, the more you benefit from this magical force. One of the biggest obstacles to long-term investing success isn't the market itself. It's our own emotions. We're wired to avoid pain and seek pleasure. And when the market takes a tumble, our natural instinct is to flee and protect what's left. But panic selling is one of the worst things you can do in a market downturn. The key is to develop a long-term perspective and not let short-term market fluctuations derail your financial plan. Investing is a marathon, not a sprint. There will be times when the market soars, filling you with excitement and optimism, but there will also be times when it plummets, testing your nerve and making you question your investment decisions. The key to navigating these inevitable ups and downs is to build a fortress of patience. Just like a seasoned captain navigates a ship through stormy seas, you too can weather market fluctuations and emerge stronger on the other side. Let's be honest, we've all daydreamed about picking the next Apple or Amazon, watching our investments skyrocket as we pat ourselves on the back for our stock-picking genius. The financial world loves to celebrate these stories of individual triumph, these modern-day fairy tales of turning a small investment into a fortune. But here's the catch. These stories are the exception, not the rule. For every person who strikes it rich picking individual stocks, countless others end up with portfolios that resemble a roller coaster ride gone wrong. The truth is, picking individual stocks consistently is incredibly difficult, even for seasoned professionals with years of experience and access to vast resources. When you buy an individual stock, you're essentially betting on the success of a single company. You're putting all your eggs in one basket, hoping that nothing will go wrong. But the reality is, businesses face a myriad of risks, both internal and external. A competitor could emerge with a superior product, a global pandemic could disrupt supply chains, or a management shakeup could send the stock price tumbling. And let's not forget about the ever-present risk of human error. Even the most well-intentioned CEOs and executives can make mistakes that have significant consequences for their companies and their investors. By investing in individual stocks, you're exposing yourself to a level of risk that simply doesn't exist with a diversified portfolio of index funds. Don't put all your eggs in one basket, the power of diversification. Remember the old adage, don't put all your eggs in one basket? It's a simple concept, but it's one of the most important principles in investing. When you diversify your portfolio, you're spreading your risk across multiple investments. So if one performs poorly, the others can help cushion the blow. Think of it like this. Would you rather own a single piece of real estate in a single city, or would you prefer to own a small slice of hundreds of properties across the country? The latter option provides much greater diversification and protection against risk. Index funds make diversification easy and accessible. By investing in an S&P 500 index fund, for example, you're instantly diversifying across 500 of the largest companies in the United States. Instead of trying to outsmart the market by picking individual stocks, why not harness the collective wisdom of millions of investors around the world? That's what you're doing when you invest in index funds. Index funds track the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. These indices are designed to represent a broad cross-section of the market. So when you invest in an index fund, you're essentially buying a tiny piece of the entire market. It's like having a team of expert investors working for you 24/7, constantly rebalancing and adjusting the portfolio to reflect the current market conditions. And the best part? You get all this expertise at a fraction of the cost of actively managed funds.
Breaking news.
Imagine you're running a marathon, but every mile, someone reaches into your pocket and takes a small handful of cash. You might not feel it right away, but over the course of 26.2 miles, those small deductions would add up to a significant sum. That's exactly what high fees do to your investments. They act like a silent drag on your returns, slowly but surely eroding your wealth over time. The insidious thing about fees is that they're often hidden in plain sight, buried in prospectuses, and glossed over in sales pitches. But make no mistake, those seemingly small percentages can make a world of difference to your long-term returns. As John Bogle famously said, in investing, you get what you don't pay for. The beauty of index funds, as championed by Bogle, is that they're inherently low cost. Because they simply track a market index, they don't require armies of analysts, high-priced portfolio managers, or complex trading strategies. This means you get to keep more of your hard-earned returns, which can make a dramatic difference to your wealth over time. Think of it like this. Every dollar you save on fees is a dollar that stays invested and working for you, compounding year after year. It's like giving your money a raise without lifting a finger. And the best part? You don't have to sacrifice performance for affordability. Index funds have a proven track record of outperforming the vast majority of actively managed funds over the long term. Now let's contrast the low-cost world of index funds with the often exorbitant fees charged by actively managed funds. Active managers are like the personal shoppers of the investment world. They charge premium prices for their supposed expertise in picking stocks and timing the market. But as we've discussed, consistently beating the market is incredibly difficult, even for the most seasoned professionals. So not only are you paying a premium for active management, but you're also taking on the added risk that the manager won't live up to the hype. And even if they do manage to outperform the market one year, there's no guarantee they can repeat that success year after year. Minimizing the bite and maximizing your after-tax returns. It's not just fees that can eat into your investment returns. Taxes play a significant role as well. Every time you sell an investment for a profit, you'll owe capital gains taxes. And those taxes can quickly add up, especially if you're frequently trading in and out of positions. That's another advantage of index funds. They're incredibly tax efficient. Because index funds are passively managed and have low turnover rates, meaning they don't buy and sell stocks as frequently as actively managed funds, they generate fewer taxable events. This means you get to keep more of your investment gains, which can make a substantial difference to your overall wealth accumulation over time. Remember, it's not just about how much money you make, it's about how much money you keep after taxes. As we've journeyed together through the wisdom of the Little Book of Common Sense Investing, one resounding theme has emerged: the enduring power of simplicity. In a world often enamored with complexity, John Bogle reminds us that when it comes to building lasting wealth, the most straightforward path is often the most effective. Remember, investing doesn't have to be a cryptic puzzle, a game of smoke and mirrors orchestrated by Wall Street insiders. It's about harnessing the power of the market, not trying to outsmart it. It's about understanding the fundamental principles that drive long-term growth and aligning your investment strategy with those principles. By embracing index funds, you're essentially capturing the market's return potential without the added stress and expense of trying to pick winners or time the market. You're putting the odds in your favor, not against you. Now, I know what you might be thinking. This all sounds great, Suze, but what about when the market takes a nosedive? What about when everyone else is panicking and selling? That's where discipline comes in. Investing is a marathon, not a sprint, and there will inevitably be bumps along the road. The key is to stay focused on your long-term goals, to remember why you started investing in the first place. It's about tuning out the noise, the daily market gyrations, the headlines that scream, buy, sell, panic, and sticking to your plan. Remember, market downturns are a natural part of the cycle. They're not a reason to abandon ship. They're an opportunity to buy more of your favorite investments at a discount. Think of it like shopping at your favorite store during a clearance sale. You wouldn't let a little crowd deter you from snagging a great deal, would you? As we wrap up our exploration of the Little Book of Common Sense Investing, I want you to walk away with a renewed sense of empowerment. You have the power to take control of your financial future, to build a life of financial security and freedom. A life where money is no longer a source of stress, but a tool to achieve your dreams. Remember, investing isn't just about numbers on a screen, it's about people. It's about families saving for their children's education, about couples planning for a comfortable retirement, about individuals pursuing their passions without the weight of financial worry holding them back. It's about creating a better future, not just for ourselves, but for generations to come.